Okay, let's talk about the stock market. It's one of those things that can seem super complex from the outside, but you know what? It's actually built on a few simple ideas. And by the time we're done here, you're gonna get them. Have you ever felt like this? You see the charts, the numbers flying around on the news, and it just feels overwhelming. If so, you are definitely not alone. But trust me, the main ideas behind it all are way more straightforward than you think. Stick with us and we'll clear it all up. So, here's our game plan. First, we're going to cover what a stock even is, then why the market exists in the first place, what makes prices go up and down, a couple of golden rules for investing, and we'll wrap up with maybe the most powerful wealth building tool there is. Alright, first things first, let's get right to the heart of it. When you buy a stock, what are you actually buying? A stock, which is also called a share, is just that, a tiny piece of a real company. And this is a huge idea to grasp. You're not just buying a little symbol on a screen. You are becoming a part owner. You're buying a stake in that company's future. So if the company does well and grows, the value of your little piece of ownership can grow right along with it. Okay, so why do we even need a stock market? Well, it turns out it's a two-way street. It helps out both the companies and the people who invest in them. If you're a company, it's all about getting money to expand. Maybe you want to build a new factory, invent a new product, or just hire more people. Instead of going to a bank for a big loan, you can sell off these little pieces of ownership, these stocks, to raise the cash you need. And that big moment, when a private company decides to sell its shares to everybody for the very first time, that is a special name. It's called an initial public offering, or an IPO. That's the switch that lets anyone buy and sell its shares on the open market. So what about the investor? What's in it for you? Well, the whole point is to make your money grow, and there are two main ways that can happen. First, if the company you invested in does well, the value of your share can go up, and you can sell it later for a profit. And second, some companies will actually share their profits with their owners. That's you, the shareholder, by sending out regular cash payments. Those are called dividends. And that leads us to the million-dollar question. What makes stock prices jump all over the place every single day? It might look random, but it's all driven by one of the oldest ideas in the book. The answer is just two words: supply and demand. Seriously, it's the same thing that decides the price of concert tickets or avocados or pretty much anything else. A stock's price at any given moment is all about how many people want to buy it versus how many people are trying to sell it. Here's how that plays out. If a ton of people get excited about a company and want to buy its stock, but not many people are selling, that high demand pushes the price up. On the flip side, if bad news comes out and everyone starts trying to sell their shares at once, that huge supply pushes the price down. It's like a constant tug of war between buyers and sellers. Okay, so now that we know how it works, let's talk about how to approach it. There are a couple of really crucial ideas that can help you navigate the market a lot more successfully. First, you've got to know the difference between investing and trading. Investing is playing the long game. It's about finding good, solid companies and holding on for years, letting your wealth grow as the business grows. Trading, on the other hand, is all about short-term bets, trying to profit from the little price wiggles that happen day to day. And while some people do that, history has shown again and again that patient, long-term investing is the most reliable way to build real wealth. The second golden rule is diversification. This is without a doubt one of the most important concepts for keeping your money safe. The idea is simple. Since you can't know for sure which company will be the next big thing, you spread your money across lots of different investments. That way, if one of them does poorly, it doesn't sink your whole portfolio. You know the old saying, right? Don't put all your eggs in one basket. Well, this is the exact same idea. If all your money is in one stock, and that company has a terrible year, you're in big trouble. But if you have your money spread out across 20 different companies and different industries, one bad performer won't be a catastrophe. It's a financial safety net. And now for our last section. We are going to talk about what might just be the single most powerful force in the entire world of finance. It's a game changer. This idea is called compounding. It's what happens when your earnings start to earn their own earnings. And the absolute best way to picture it is a small snowball at the top of a very, very long, snowy hill. At first, it's tiny and moves slowly. But as it rolls, it picks up more and more snow, getting bigger and bigger and moving faster and faster. So let's imagine you invest $1,000 and you get a 10% return in the first year. Now you have $1,100. That's great, but it's not life-changing, right? Your snowball is just getting started. But watch what happens if you just leave it alone. After 10 years, that same $1,000 could be worth almost 3 times what you started with. How? Because you're not just earning interest on your first $1,000 anymore, you're earning interest on the interest. The snowball is picking up speed. And here's where it becomes truly incredible. After 30 years, that little snowball has turned into an avalanche. This is the magic of compounding. Time is the secret ingredient that turns small, steady gains into serious wealth. And the biggest lesson here? The sooner you start, the longer your snowball has to roll and grow. So let's do a quick recap. What did we learn? Number 1, stocks are just pieces of ownership in a business. 2, prices move based on simple supply and demand. 3, thinking long-term is crucial. 4, diversification is your best friend for managing risk. And 5, compounding is the amazing engine that builds wealth over time. Look, the stock market can seem big and intimidating, but as we've just seen, it's really built on a handful of core ideas that anyone can understand. The most important thing you can do is just start learning. So the real question is, now that you know the basics, what are you going to do with that knowledge?